Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today is our favorite day, the Primary Vision Frac Spread Count. So we're going to go through that, what are some of the things that have changed now that we're through first quarter, starting to see some of the reporting coming out from the different companies. And then we're just going to update on what's happening with OPEC and then some just recent data points that are interesting, and then we'll go through them in more detail for the Econ show. So we had a small decline. This is we finally had a small pair back of three spreads. So we did get a little bit of a dip in the Permian, but it was offset by some additions in some of the other fringe or smaller basins. And one of the things that we've been saying is that we, seasonally speaking, we normally start to see some activity in some of the smaller, some of the fringe basins. And last week, it happened all at once. We were assuming a little bit of a walk up, but last week we had all of them coming, many of them coming online. And now the residual 2 or 3 that didn't come on, pick up activity last week is picking up activity this week, which is making up that difference. So, rig counts are essentially flat. There was oil rigs were down 1, gas rigs were flat, and then the 1 rig went down in the Permian. So again, we're starting to get to this point of pause where now it's okay. Well, where do we sit? What is the available equipment? And when we were talking about this on Twitter, somebody asked a great question, because we had said that 230 was going to be kind of that pause point when you look at available horsepower, and that, which is still the case. We're not saying that isn't, but now given how the speed in which we've gotten to these points, and I think it's good to look at kind of where we sit here when you can see that the bounce and then the steady move up. The speed in which we've gotten to this 200, 220 level is pulling some of these conversations forward by a quarter. Now you're starting to have, okay, well, what do we have that's cold stacked? What needs to be repaired, rebuilt? Do we have to buy new equipment? Is there spare equipment out there that we can buy for, well below replacement cost and fix it to our standards? And these are the kind of conversations that are going to start happening. We're also coming into the seasonal pivot. We had some late season cold that came through that's going to slow down some of the additions in the Bakken. DAPL continues to be this kind of unknown on what's going to happen. But again, this is why we think we get this point of pause as these conversations start to happen, and then we will start to see some acceleration into May, into June. But over the next, let's call it the next 2 to 3 weeks, we should see this kind of hang, and in the report that we put out today, that 220 was going to be the high point for just a small period, a window of just, okay, let's see where we're sitting right now. And then when we look at where we were versus 2020, you can see that obviously there was this nice little drop because of COVID. But when we look at this on a seasonal level, we're actually kind of following where we were in 2017. When we look at this steady rate of change, a little bit of a pause, and then the continued rate of change is the same. We're obviously at a much lower level than where we were in 2017, but the pace is very similar. So I think that's something to consider, especially if you have our data and you can start to look at, okay, well, what was 2017? And you get an idea of kind of where we're sitting. Now, a quick overview of the OPEC comments and what's going to come into the new meeting. So we had a chart in the EIA show looking at OPEC spare capacity, and this is kind of the rebuttal to that. So the comment in the EIA show was, well, we have 8 million barrels sitting on the sidelines, which doesn't include Libya or Iran. But, and when we had a super cycle, we were really at 1.7. Well, this just looks at it and, okay, well, what's the forecast? And this is the S&P global forecast of where we get some production coming back. And so you can see that the idea is that the spare capacity is going to get whittled down over the next few months. Now, the question that's going to come into everyone's mind, especially as we go into the meeting, what's going to happen with Asia? And I don't think OPEC changes anything right now. I think it's going to be steady as she goes in terms of the May increases, June, July increases. But I think they're going to start to put some color around. They're going to look closely at June and July, given what's happening in India, Japan, South Korea, but more specifically India. And let's put that into context. So right now, India's COVID wave has brought an abrupt halt to the recovery, where right now the diesel gasoline for April is expected to be down about 20% month over month, which it was already coming down, which is starting to create some of this friction. Now, the other side is India's biggest oil refiner so far has not issued a third tender. So they were supposed to issue, typically you issue multiple tenders of, I wish to buy X from this country or this grade. So they've issued 2 for West Africa, more specifically Nigeria. They've purchased about 13 million barrels for June, July delivery, and there was supposed to be another this week, and so far that it hasn't come through. And now with what is happening with COVID, now we're starting to hear about resales or deferrals, which just means that this third one's not going to really come through. So there's now some concern about, well, what is going to happen with West African cargoes? We're starting to see that slip a bit into the Middle East, where we're starting to see a little bit of that friction that we talked about in the EIA show on some of the pricing on SOMO and Basra coming out of Iraq, and now just in terms of where some of these numbers. And then it's complicated even further by Urals crude exports from Russia's 3 main Western ports will rise in May to the highest in 13 months. So you're starting to get a little bit more from Russia. There's going to be a little bit extra that's left in the market now with India. And this is kind of this back and forth that they're competing with. Now on the refined product side, Europe's imports of refined products from the Americas, which is typically middle distillates, is the lowest it's been in about 3 years. Only 304,000 tons of clean fuels are expected to arrive from the Americas. But European imports of oil from the Middle East, which is mostly middle distillates, is actually going up to a 6-month high. So you're kind of seeing this, they're starting to play this game a bit, because we did get some decent drawdowns out of Europe. We had a small drawdown from Singapore, but not too much, which is going to be something to watch. But the Middle East is losing where to send product. Typically they send into Africa, Asia. Now you're starting to see some of that reverberate back, and you're getting it pushed into Europe. Now, don't get me wrong, Middle East also sells into Europe normally. It's not like they don't. It's just they're going to have some additional cargoes that are going to flow through. So these are going to be things to watch, specifically on the physical crude side and the refined product side. Now, with some recent data coming out of the U.S., in terms of where we sit, this is looking at manufacturing PMI, services PMI, then the composite, which were all strong. I mean, there's no way around it. They're good numbers, they're strong numbers, but we have to put it into context as to, okay, well, where are we in that cycle? So the manufacturing in April came in at 60.6. The estimate was for 61. So it's still better than last month at 59.1, but starting to see a little bit of a slowdown. But we're going to go through what's making up this number, where on the services side, came in at 63.1 versus an estimate of 61.5. So as we've been saying since the end of March, the services was really going to be that big driver, as we have restaurants, bars, things opening up, not just on a seasonal level, but also just that reopening as people are vaccinated. You get a little bit more movement, which is, again, pushing this through, which is why employment has remained strong. The problem is the manufacturing side is starting to get hit to a bigger level with the raw materials and delivery. So let's break this down into pieces. The rise in manufacturing production, weighed down by difficulties sourcing raw materials and the ongoing supplier delivery delays, which were the most extensive on record. Now, this is why we keep talking about these delays, where with the problems that are now happening in India, other parts of Asia, strikes and all these friction points, we're continuing to see these delays. And now with the on a semiconductor side, the largest lead time ever, it's not going away anytime soon. And that's the biggest concern for, okay, well, where is this going, and how is that going to impact pricing? At the same time, total new export orders rose at the fastest pace since the composite data started in 2014. Again, that's a net positive, which means that even though we have export prices that have gone up, people are still willing to buy, which is a positive for some of that future manufacturing. Average cost burdens continued to rise in April as higher fuel, wage, shipping, and PPE costs drove inflation. The rate of increase softened slightly, but was still one of the fastest on record. The rate of change inflation quickened, however, as stronger client demand allowed firms to pass on a greater portion of hikes. We just got that from Honeywell. We've gotten that from P&G. So in line with an uptick in customer demand, the level of outstanding business rose at the steepest rate. So again, net positive for that business. But on an aggregate now, looking at the composite, the worsening supply situation is a concern for the outlook, especially in relation to prices. Supply needs to improve to come in line with demand, but with record supply chain delays driving a rise in backlogs of uncompleted work of a magnitude not surpassed for over 7 years, firms appear to be struggling to boost operating capacity in the near term. So that's where we're going to continue to get some of this friction. And again, business inflation being passed over to the consumer, and at some point the consumer is going to push back or not be able to meet those new numbers. And then on the other side, housing had a nice little pop after February. Solid rebound in March. Home sales came in at 20.7% versus the estimate of 14.2%. And then when we look at prices were up 0.8% year over year to $330,800. Average selling price at $397,800. Month supply continues to fall. So again, the housing side, it still remains strong. We still continue to see pricing. And that's leading again to that inflation in terms of rent. Where is this going to go overall? This is again continuing to drive to highs. Now, when we look at net worth, just to reiterate this, and this is something from looking at the top 1% versus the bottom 50%. So since 1995, the bottom 50% have added 1.5 trillion to their combined wealth, while the 1% have added 30 trillion to their combined wealth. Now let's break this down. The 1% is 3.2 million people. The 50% is 165.5 million people. So you have 30 trillion across 3.2, and then you have then you have 1.5 trillion across 166 million people. Again, this is these are things that bubble up over time in terms of income inequality, wage inefficiencies. And when you look at and layer this with inflation and other types of just costs going up, because when you think about Honeywell and what they make and how it touches almost everything within our lives, then you look at Procter & Gamble, another company that touches many people's lives. They're the bellwether for where this is going. And when people come back to me and say, oh, well, things are getting really strong, it's like, I never said that they were not going to get strong. My whole thing was, what is driving the strength and is it sustainable? And then the next question is it priced in? When you look at the industrial stocks, how much of this isn't priced in? And now something that came from Goldman in terms of just some commentary on ISM, when we look at the ISM side, so when the ISM manufacturing index registers above 60, typically coinciding with peak growth, the S&P has a medium return of negative 1% during the subsequent month and just a positive 3% return during the subsequent 12 months. So again, we're obviously in unique times, but just to kind of put that into context. And looking at that a little differently, this is what we were talking about when we were going to see a rehashing of where the numbers were going to fall. And when you look at the April data, you can see that there was a reclassification to the pandemic unemployment assistance emergency. So that's why when we were saying going from that 16.9, we expected to see that bounce back to about 17.5. 17.5, it came in at 17.4. And it comes down to, the new claims are getting better, but again, the continuing claims continue to get a little bit worse, and they're all falling under that pandemic unemployment. And just to kind of put it into context, this is where you could see the regular benefits continue to fall off. Even the pandemic unemployment assistance is starting to come down a bit, but all of the pandemic emergency unemployment compensation and the extended continue to be the elevated side, keeping us, at this elevated level, which should continue to go down, just as we've been saying, at a much slower rate of change. Now that we had that big surge on the jobs front. And then just to kind of pull it out a bit, just so you can see just what with the flat line that we're talking about when we're just looking at pandemic specific activity, this is what we've been talking about. And this is the overhang that we continue to see with consumption, especially as you have rates going up on prices, and not, on the company side, it's starting to slow. And that's what we've been saying. It's going to reach a peak and then kind of flatline. And that's where we think we are right now. But the pass through to the consumer is just starting to accelerate. And that's something that we think is going to continue to happen. So even though PPI and the company is going to pause for a bit in terms of new prices paid, the prices received is going to be the one that's going to get some of that push through. And the reason why we talk about that being such an issue is when we look at the low wage workers and the struggle to get back to on that recovery side, when you can see the low wage that below $15, even the middle wage is slowing down, high wage is getting better. Now the middle wage is starting to get and some of these are starting to pick up now that we're getting some of the restaurants back open. So it has turned up, but the middle wages, you're really kind of flatlined, and the low wages is just not getting to close that gap. So just to give you an idea, business closures and voluntary consumer behavioral changes made in response to the spread of the virus hit sectors and occupations employing lower skilled workers and minorities the hardest. So employment in low wage jobs with earnings less than $15 an hour remains 14% below pre-pandemic. And this contrasts with high wage jobs with earnings more than $40 an hour, where employment has grown 9% over the course of the pandemic. So this is that bifurcation that we continue to see. And as the benefits outweigh going back to some of these lower wage jobs, we're going to continue to see that friction of, well, the job openings that are there, but they're struggling to get filled. And that's where we continue to see this underappreciation. Now, when does that adjust? Is it when we start pulling back on some of the benefits? These are the indications or things that are being considered and discussed in Congress right now for the infrastructure bill. What should it really look like? Should there be a little bit of a pare back given the stimulus that has already come through? And again, these are going to be the debates. Now, the biggest one that came out was on the tax rate. Everyone panicked when the tax rate was, specifically cap gains, was supposed to go higher. That'll most likely be negotiated down. We do expect to see an increase. What that increase looks like will be something, I think, a little bit lower than 43%. But again, those are the concerns, because there's nothing that will stop a consumer faster than uncertainty on their tax bill. If you don't know if your tax bill is going to be 10,000, 15,000, 20,000, that's going to impact the way you spend, especially now when you see inflation or you're seeing prices start to go up. And then on the wrapping up the geopolitical front, Russia did have started to pull back machinery, equipment, and personnel from the front lines or from an area that was concerning, especially when we look at Ukraine. But they're not pulling back all the way. They're pulling back to bases that are further away from the front, but still pretty close to a mobilization point. But again, all of that is still a net positive. It looks like, conversations or communication lines are trying to be reopened. So those are net positives when we think about some of these friction points that we highlighted in the econ show. So we went through a lot, I would keep this a little bit shorter, or trying to. We had a lot of data come out with the EIA and econ show. We'll have more for you next week with our normal lineup of the EIA, econ, and obviously our favorite, the Primary Vision Frac Spread Count show. So thanks again for watching. I'm Mark Ursano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Have a great weekend.